Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So pressure seems to be building on Fed Chairman Jay Powell from the White House. President Trump out on social media this morning urging the Fed to lower interest rates and challenging Fed Chairman Jay Powell personally, on a personal level as well, it seems like. Tom Orlik, Bloomberg Economics Chief Economist. Hey, Tom, how concerned should the marketplace be about President Trump and the political pressure he is applying to the Fed and to the Fed Chairman?
Well, I think there's a couple of reasons to be concerned about it, Paul. The first reason is that we have central bank independence for a reason, right? The experience from the 1960s, the 1970s, when monetary policy was dominated by the concerns of the executive branch, was that, well, that was a big contributing factor to inflation running much too high for much too long. So if you're in the bond market, if you're in the FX market, if you're in the equity market, that's clearly a big source of concern. The second, of course, is the signs that we're seeing from the administration. And I think we can think about that on two lines. The first is legal moves that you probably wouldn't pay too much attention to if you weren't an expert, but legal moves which chip away at the basis for Fed independence, asserting a presidential right to fire the heads of other independent agencies. And legal scholars say, well, what's really going on there is that the Trump administration are laying the groundwork for a potential move against Chair Powell. And of course, we don't need to go further than Trump's Truth Social account to see the president's animus, right? A clear view that the Fed is taking the wrong path, and Powell's, to quote Trump, Trump's termination can't come soon enough.
Okay, so to that point, let's just game theory this out for a second. What would happen if the Fed cut rates?
So I think the concern is that inflation is still considerably above the Fed's 2% target. So if the Fed moved to cut interest rates at this point, I think the markets might reasonably conclude that it was doing so on the basis of political pressure rather than economic logic. And that would be a step to chipping away at the Fed's credibility as an inflation fighter. And it's that hard-won credibility stretching back from Volcker through Greenspan, through Bernanke, through Yellen, and now with Powell, which is key to keeping inflation expectations under control.
Tom, so what's your concern here, I guess, about the dollar here? We've seen just pronounced selling of the dollar. We're down about, the Bloomberg Dollar Index is down about 8% from its recent highs. What does that tell you?
So it's interesting, Paul. The economic textbooks tell us when a country imposes tariffs, its currency should appreciate. But here we have the US imposing sweeping tariffs against all of its major trade partners, and its currency is depreciating. So what's going on? Well, I think there's a few potential contributing factors. The first is that, well, the president himself has told us that he favors a weaker dollar to support competitiveness. Don't fight the Fed on interest rates, maybe don't fight the president on the exchange rate. The second is that by imposing all of these tariffs, the US is effectively saying it's going to play a smaller part in the global trade system going forward. And if the US is going to play a smaller part in the global trade system, well, maybe other countries, companies in other countries don't need to hold so many dollars. And then the third, and perhaps this is the most troubling, is, well, confidence in a currency is underpinned in a sort of fundamental way by confidence in its growth prospects and confidence in its institutions. We really can't draw too many conclusions from just a few weeks of dollar decline, but certainly the contrast between what the textbooks say, tariffs mean a higher dollar, and what's actually happening tariffs combined with a weaker dollar, do suggest that perhaps the markets are starting to have a little bit of concern about US longer-term growth prospects and potentially about US institutions.
So, Tom, to that point, when we talked about what happens if Powell does cut rates, I mean that's a very emerging markety thing to kind of do, right? Then you have high inflation. Can you grow your way out of it? You mentioned the dollar and the question marks around the dollar not following rates higher, for example. You worked in Beijing for many, 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 many years. Is it fair to say that the U.S. is trading like an emerging market?
So I think that's I mean, I certainly appreciate the analogy, Alix, and I think some of the dynamics are sort of pointing in a kind of similar direction. But I think we need to think about magnitudes as well, right? And we also need to think about the credibility that the US has built up over not just years but decades, right? So do some of the dynamics here have a kind of echo of things that we've seen in emerging markets over the years? Yes. Are we in the type of extreme situation in the United States that we've seen in, for example, Turkey in recent years? No, we're still quite some considerable distance from that extremity.
All right, Tom, thanks so much. Always appreciate getting a few minutes of your time. Tom Orlik, he's a chief economist for Bloomberg Economics. He is based down there in Washington, D.C.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Within the markets, taking a look at an S&P off by 2%, NASDAQ off by 2.6%. We are picking up that steam to the downside. Volume, though, pretty light. Most of Europe was closed for Easter Monday. Phil Orlando is Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes, and he joins us now. Phil, do you buy these dips?
First of all, Alix, happy Easter Monday to you. No, we remember that last week, Easter and Passover week, the markets were closed on Friday. You had a lot of market participants with their kids off from school taking, extended vacations and the like. And we had a bounce to the upside in the stock market once President Trump, I guess, backed away from the hardline tariff news and instituted sort of a 90-day cooling off period. We were expecting that as market participants, filtered back into the market this week, we could see a retest. On the equity market, that would suggest taking the market back down to that, 48.35 level we saw a couple of weeks ago. On the bond market, benchmark 10s, perhaps yields, backing up into that 4.5% neighborhood. So, again, now that you've got the players back in their seats, I think you've got to sort of let this play out and see where the support levels, technically speaking, play out, and if there's any policy news that comes out of Washington. We saw the Federal Reserve last week basically tell us that there's no Fed put. They're not in any hurry to change policy. They're going to be very patient and wait to see if there's a confluence of the solid hard data and the sloppy soft data. So that would suggest to us that we're not going to see anything out of the Fed before the June meeting at the earliest. I think we've got the luxury of time here and just, be patient and not try to chase this.
Phil, one could argue the weakness in the equity markets, in the U.S. dollar, is a reflection of the economic uncertainty caused in large part by the tariff discussions and the tariff news. Is there any reason to think that narrative changes in the next 6 to 12 months? Tariffs seem to be the tool of choice here for this administration.
Well, I agree with your point on the currency. Dollar euro, for example, which was, right around par or so, beginning of the year, we're sitting at about 115 now. So you've had a pretty significant move in a short amount of time. Treasury yields, went from 4.5%. We were down at 3.85 or so. within the last month or two. Stock prices were up at all-time record highs in the middle of February. So you've had a lot of volatility in a relatively short amount of time. And all of it relates to the uncertainty on tariffs. Now, just look at the earnings season. We're only 10% of the way through the earnings season, but revenues and profits have been better than expected. Yet, when managements are going through, their assessment, the guidance has been very conservative, and some companies giving us two sets of guidance. Well, maybe we have growth, maybe we have a recession. This is what we see. So there's no visibility at all because we have no visibility in terms of what the tariff policies of the administration will be. So how can companies or investors plan not knowing what the rules of the road are?
Totally right. So when you take a look at earnings season, what would constitute a good earnings season? Like a solid first quarter and honesty about the rest of the year? Like, what do you want to see?
I mean, that's the gist of the piece that I wrote last week, that if you look at the stuff that we know, the inflation data coming down, consumer spending strong, the labor market strong, corporate earnings season, early days, of course, but strong. Yet the market is the financial markets are in a kerfuffle because the rear view mirror stuff that I just talked about almost doesn't matter because we don't know what the next month, 3 months, 6 months, 9 months, a year look like because we don't know what the policies are in place. Now, is the administration using the tariff kerfuffle, if you will, as a means of drawing trading partners to the table and negotiating better terms, in which case all of this volatility maybe sort of fades and the longer-term picture looks great? Or are we looking at these massive tariffs ad infinitum, and it has a materially deleterious impact on economic growth, inflation, financial market performance? You've got two very different paths there, and we don't know which path to take.
Hey, Phil, 30 seconds left. Does Fed Chairman Jay Powell have reason to worry about his job security?
We don't think so. Fed independence, in our mind, is absolutely sacrosanct. We think the administration is going to wait until Powell's term ends in May, go in a different direction. But I think what you're doing is the Trump administration sort of playing the refs a little bit, trying to get the Fed to recognize that inflation numbers are down, based upon where the funds rate is, and the Fed does have room to cut, in our view, starting in June.
All right, Phil, thank you so much. Appreciate that. Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes. Joining us there, talking about the Fed.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Obviously, one of the big news stories of the day, Pope Francis, promoter of more compassionate church, dies at the age of 88. The pontiff was praised for his focus on poverty and human suffering. He was born in Argentina, and he became the first pope from the Americas. The question is now, where does the Catholic Church go from here? Let's get the latest reporting. Ros Mathieson joins us, Bloomberg News Director for Europe, the Middle East, and Africa. So, Ros, can you frame out for us kind of how the process will work, the time frame for electing a new pope?
Well, it could be quite a lengthy process. I mean, historically, at one point, it took years to select a new pope through this process known as the conclave, but it can take weeks or even months. And it will be interesting to see in this case, obviously, because Pope Francis really pushed the Catholic Church through his leadership in a more socially liberal direction than his predecessor. And that wasn't without controversy, obviously, within the church. So are we going to see a contest here between the socially liberal wings of the cardinal group? Or are we going to see a return to a more conservative, theological, less political even agenda? And so this conclave is likely to begin possibly within about 2 weeks. Normally it takes about 15 days after the news of the Pope's passing, or the Pope abdicating, for example, as has also happened previously, and then all the cardinals gather. But it can only be 120, and right now they're 135, so they'll have to work that out. And then they essentially come together, they put all their electronic devices away, and they get locked up day after day while they come and have a series of votes every day to reduce the group of candidates until they get that white smoke that we know that signifies that we have a new pope. And that process at this point, it's hard to know again how long it could take once it begins. It could be over in a matter of days, but it has taken weeks or months previously.
Wow, that's definitely going to be quite a process. Ros, do we have a sense of, I mean, just talking about politically, can you just give us some broad strokes as to the time and moment of choosing this next pope in such a politically divided world?
Well, of course, Pope Francis wasn't shy about wading into the politics of the world. He often spoke about the conflicts that we've seen with Russia's war in Ukraine, the conflict between Hamas and Israel in Gaza, talking about the need to be compassionate, to have, care for those who are poor, who are suffering. And he included migrants in that. So he often talked about the need to be more compassionate towards migrants, which put him a little bit in the crosshairs of countries, including the US politically, under Donald Trump. And so he's really kind of put the Catholic Church in a slightly different direction there in terms of politics of the day. And we are arguably in a very polarized moment globally. You can see the rise of more conservative administrations again in the US. You can see the rise of the far right in Europe, in parts of Europe and elsewhere. And do we see, the selection of the Pope coming into this idea of what kind of world are we in, and what kind of world is the Catholic Church and its leadership going to represent in that world? And does the selection of the Pope, dare I say, become politicized because of it? I mean, It always is probably to some extent, but does this become even more so as a result?
Yeah, absolutely. All right, Ros, we really appreciate it. Thank you very much. Ros Mathieson, Bloomberg News Director for Europe, the Middle East, and Africa.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
As we were discussing earlier, the market continues its downslide. You're looking at the Nasdaq almost off by 3%. Julie Biel is Chief Market Strategist and Portfolio Manager at Kayne Anderson Rudnick, and she joins us now. Where's a safe haven right now, Julie?
I think for your long-term investors, this is good opportunities to be able to scoop up some of those companies that are good quality and will be around for the long term. You just have to be willing to buy those and then forget about them. I think it's a really difficult time right now for long-term investors. They want to be able to call the bottom, and it's really not possible to be able to call the bottom. You really have to be confident in what you own and be able to kind of sit still, not try to make a whole bunch of trades, and just try to own the good quality companies that you think will be there on the other side of this valley.
Julie, I like it in your notes, you quote Howard Marks, who said last week, quote, "There is no place you can look, there's no analysis you can do to determine whether today's asset prices are right for the environment ahead." Given that backdrop, I guess it's easy for a lot of people to just kind of sit on their hands here. Are you trying to be tactically smart here? Are you sitting on your hands like a lot of folks probably?
Yeah, I think Howard Marks also says this great thing that I love so much. The old adage of like, don't just sit there, do something. He says, don't just do something, sit there. And I think that is something that is very difficult.
I can totally do that well.
In some cases, on Saturdays, I'm great at it. Totally. But in many cases, a lot of clients will be asking me, oh my God, what are you doing right now? What's changed in your process? And the answer is actually not very much, very little, because I have a lot of confidence in the 28 or so companies that I own in my portfolio. I know that they can get through difficult times because I have evidence of them being able to manage through difficult things in the past. The great thing about COVID is we really got to look and see how adaptable companies are to really difficult situations. And so when you find those types of unsexy businesses that are kind of the resilient cockroaches, those are the ones that you really want to own. And then you have to resist the urge to try to add value by doing a bunch of stuff. No more hand waving, just sit still, own good companies, do the research, and really try not to be a hero. That's not what this time is about.
This is why I love Julie. What are my resilient cockroaches? Like, yes, bring that on.
So what's it?
No, really, what are the resilient cockroaches?
the resilient, I really like the businesses that, are more data businesses. So a Verisk, where, they are the ones taking in information from insurance companies and then selling it back to them. Great business model if you can get it. That's always going to need to exist, and that's not necessarily going to be interrupted by tariffs. You're going to see just a stability and a predictability to the earnings, and that's actually what you kind of want to be looking for right now.
So what do you make of the adage of just buy value here? And I hear that a lot, particularly in times of uncertainty or stress in the marketplace, really go up the value chain. Do you ascribe to that? And what does kind of quality mean to you?
So I think that when I think about quality, to me, it is about the durability of the earnings, right? And so the style of it, whether it's growth or value, to me is much less important, rather than can I predict how this business is going to perform in a downturn and how is it going to recover? That's way more important to me. I think when you're thinking about value, and I think why value has been more resilient thus far, is that you just do not have this valuation challenge and headwind that you had in growth, where you saw so many of these ultra high multiple companies. And remember, high multiples are just a function of like, how high are people's expectations, right? And the thing about expectations is your heart just gets broken when you don't meet them. Just ask my parents, right? Their heart's broken all the time.
Lies.
So it's so important to kind of recognize that when you have high multiples, you have high expectations. And if you don't meet them, you're really going to get crushed. Value stocks just don't have that same problem. Their valuations are much more reasonable. And so people feel more confident that they can own those. The thing is that there's a lot in value, the traditional value, that's very cyclical. And so I wouldn't necessarily say it's a great idea to be buying low multiple cheap stocks that are cyclical when you feel like there may be economic turbulence ahead.
Right. And I guess the question is, there's been a big move in value anyway, right? So it's sort of like finding value within value.
Yes. I think we don't love the term value, right? Because I think for us, what's more important is thinking about, if you're thinking about a growth company versus a value company, I think it's better to think about it in terms of its maturity. And so a growth company, they can really use their capital that they generate internally. They still have a lot of growth opportunities internally. A value company is better served giving that cash back to shareholders because they're in a more mature market and they don't need to invest internally as much. When you separate it from that, then you're not as married to things like, okay, if I'm a value portfolio manager, I need to own a ton of banks, which no thanks. But if you're a growth manager, you don't necessarily need to think about yourself as having arbitrary, I need things to be growing 20% or I'm not a real growth manager. I don't think you need to be quite as didactic. I think it's more important that you just own good quality all the way through.
So how much earnings risk do you think is out there in the marketplace, Julie? Because I've seen estimates come down, but I'm not sure they've come down enough. How do you think about that?
I agree with you. I think that I don't put a lot of stock into earnings estimates to begin with, right? If it were up to me, companies wouldn't issue guidance because I just think it's a crazy exercise when you have this much uncertainty. But what I will say is that I am surprised how much people are kind of paralyzed with their estimates. They're not taking them down. They're not really taking them down very much. And I think that that's just a reflection of what for the first quarter is going to look like in terms of earnings results. I think that I'm worried that you're going to see a lot of companies deciding to suspend their guidance, which I think is fine fundamentally, but I think it will spook investors if they don't have that kind of crutch of knowing what is this business going to earn. I don't think it's that important. I think what's more important is, can it continue to earn these good earnings over the long term? But in the near term, people are very dependent on these earnings estimates to kind of guide their decision making. And if they don't have that, I really worry it'll lose, that we'll have a loss of confidence.
One thing we did have is capex spend, particularly from the hyperscalers. And I'm wondering if you're expecting any sort of a shift on that at all due to the uncertainty.
Yeah, I really wouldn't be surprised. I think they have a lot of cover to be able to pull back that spending now. It's a great excuse for them to be able to say, oh God, things are really wacky and crazy. It's not that we haven't come up with a good earnings economics model around this billions of dollars of capex investment, it's the tariffs. So I think that they have good cover to do that, and I think it would be a positive thing because I think until we have a lot more clarity on how we're going to monetize all of this investment, I think it really gives a lot of investors pause. And I think this is a great opportunity for them to really prove out all of these promises that they've made for the level of capex. But it's important, right, for the broader economic outlook, right, because so much of the capex growth that we've seen in the last 2 years has really been driven by the hyperscalers. If we don't have that, do we still have a great economy that, people want to invest in? It's less clear.
100%. And that was sort of the question mark that, is it just the Mag 7 and everybody else at the end of the day? All right, Julie, thanks a lot. Really great to get your perspective. I love the Brazilian cockroach. I'm definitely using that. Stealing it. Julie Biel, Chief Market Strategist and Portfolio Manager at Kayne Anderson.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.